We know markets are really oversold. We know that investors have had a lot of de-risking. And this week, I think into April 2nd, investors have three things on their minds. One is they just don't know what the tariffs look like. They don't know if it's going to damage the economy. And I think third, many are just a little terrified of the policies of the White House. But post Wednesday, I think markets are going to have some visibility that allows us to take some of the selling pressure off. So yes, I think it's possible that instead of us breaking down here and seeing markets under further pressure, we're actually got the right pieces
buy,
for
though,
bottom.
into this without knowing what's on the other side of it? That is the fundamental question that people are sitting around trying to figure out today and tomorrow.
I mean, there's a lot of distortions of the economy now, right? It's an interminable wait for people because it is still 3 days, and they're fearful that over the weekend we had so many thinking the economy is going to completely fall off the rails after Wednesday.
Financial analyst and Bitcoin bull Tom Lee breaks down what's really happening in the market. Bitcoin, a risk asset that thrives on liquidity, is setting up for a bullish run. Bitcoin's price currently sits just over 82,600, still up over 18% in the past year. Lee still stands by his long-term target of $150,000, and with seasonal headwinds fading, he says now is the time to start stacking. Let's get right into the latest interview with Tom Lee, as he gives his market prediction for the days and weeks ahead.
Brexit's an example. Brexit happened and the UK economy emerged okay. It didn't have a huge recession and the stock market did okay. So for investors today, over the weekend, we had so many thinking the economy is going to completely fall off the rails after Wednesday. I mean, there's a lot of distortions of the economy now, right? Because we know people are buying cars and wine ahead of tariffs, and that's creating inflation. I think it's possible economists are only dialing in the negative consequences so far, but not the positive, because rates are down and gasoline's down, and there could be some pull forward of demand. So we might end up having better growth, so less stag, and maybe the inflation stuff is more distorting, and so it's not as stagflationary. It's interesting because Goldman did raise their inflation forecast, but then they're talking about more rate cuts.
I know, which is because of growth concerns.
Yes. And I think we'll have a glimpse of what Fed Chair Powell's thinking, because he's speaking Friday after the jobs report. And I do think that it remains a more dovish Fed than many expect. I mean, I think that's what was revealed after the March FOMC meeting. And not that I'm saying it's going to put a reversal of markets here, but I think investors are a little too scared heading into Wednesday.
Bitcoin's testing recent near-term lows, I guess, again. It's been under 80. It's not quite there yet, but it also really likes the idea of more Fed rate cuts or the Fed being more lenient. So if we get that on Friday, is this a decent time to be stacking?
I think so.
You do, at 80.
Yeah, I think, part of this was Bitcoin seasonally was just not going to be attractive until after March ends, and now we're finally exiting March. And so I think not only is the calendar looking better, but as you're saying, the Fed and central banks are easing, QT's ending. I think that with positive Washington sort of tailwinds means I think Bitcoin can do well to the end of the year. And I mean,
one crazy high again?
I think it's still 150 or higher as possible. Okay. I know it doesn't feel like it, but once we get through this tariff and that agenda around tariffs, markets can look forward to things that could be positive. But we know markets are really oversold. We know that investors have had a lot of de-risking. But I kind of agree with Larry Fink. I think the U.S. is going to come out of this okay.
You agree with what Larry Fink said just about the idea that the dollar could suffer as a result?
They wanted
Bitcoin.
to.
Yeah.
Yes. I mean, I'd say that Washington understands that, too. That's why stablecoin, really getting the right sort of legislation for stablecoin is important, because In crypto, when it comes to stablecoins, the dollar is way more dominant there than it is in traditional markets. So I think you actually kind of protect the dollar with stablecoin legislation.
Embracing an unyielding enthusiasm for the Bitcoin realm, Lee confidently predicts that explosive growth is looming on the horizon, as BlackRock and many other crypto giants are doing just that. Tom Lee reassures that a long-expected surge awaits as we head into the second quarter of 2025. Now we'll hear Tom Lee break down what implications the Fed rate cuts have and the current risks the market faces.
I've seen this chart, and but the one thing I'd say is that there's wide distributions in year 3. So there's actually plenty of 20% years.
Okay.
So it's not like, because this chart makes it look like you're only going to be 5% and like you hover, like year 3 also reflects bull markets end and then you have a huge decline.
You have a chart showing that the second half after a back-to-back 20% year tends to be pretty lousy.
Yes.
What are we looking at here?
This is all years that had 2 consecutive 20% years preceding it. So that's like that first vertical line says year 0. And then we're just saying, what does that 12 months later look like? And as you can see, you might be okay in the first half, but the second half is usually tougher.
Sorry, is that 1880?
I saw that too.
Yeah.
Is that like Yellowstone?
Tom was digging deep.
Okay. So this is not...
We were like still shooting pistols.
Yeah.
We're not following that. We're not tracking.
So this is not wildly out of character for what typically happens after you've had a big run in stocks.
Yes.
The reason why I believe in this stuff is because it's just human behavior.
Eventually,
It's fear and greed.
we know good news gets priced in, and then it's
Yeah.
hard to determine. But then after a certain amount of time, people might get complacent or whatever you'd call it.
The S&P is driven largely by tech stocks, but the Russell 2000 has much more exposure to rate-sensitive industries. So is the thinking that if the economy weakens and rates go down, that the Russell would maybe go down less than the market, or do you think that it would outperform in a bull market? What's your thinking here?
I don't think if there's a recession, small caps outperform. So like on that downside, I don't think it's protected. But if we look at the composition here, I actually am surprised it's done so poorly because, for instance, healthcare's the best performing sector year to date, and you can see healthcare is a bigger weight in small caps. Financials have done well year to date; it's a bigger weight in small caps. Industrials have outperformed year to date, and it's a bigger weight. You have less exposure to tech, and
So what's weighing the small caps down this year?
I think it's the push button because
Just people saying sell small caps.
It's higher beta.
Yeah, so they're derating. They got cheaper.
Okay.
Oh,
Not
wow. Small
because-
caps are down 15% in a 50% drawdown. I didn't realize that.
Yeah, so that it's not like someone's doing relative value.
They're selling the ETF.
Yeah,
They're selling
just
IWM.
Selling IWM.
It's like the first thing people sell.
Yeah, financials, industrials, healthcare. That's like that's already more than half of the Russell. So it should be a good index, but and I think the individual stocks have been, but as an index, hasn't worked.
On the inflation side is if the Fed thinks they have to about face. This, like, to me, if you ask me what's the biggest risk that people aren't as worried about now as maybe they should be, it's if the Fed says they're not tight enough. And the only thing in my mind that could drive that is not commodity prices from tariffs.
Because it's sort of like the new administration's trying to recast relationships, which was traditionally like sort of free trade, status. And if I look at Brexit, by the way, the UK stock market did fine. Like
It was one of the biggest buying opportunities of the last 10
Yeah.
years, the summer of 2016.
Yeah, and it didn't upend the economy.
Yeah.
You didn't have an inflation problem or a growth problem. It was sort of like, the UK got through it. And I'm confident that that's where we are 4 or 5 months from now. I think that they thought one of the collateral hits to this would be the stock market because, okay, we're going to put these threats on and we want our other countries to take it seriously. They would want the stock market to decline.
Yeah.
Because if the Dow and the S&P were rallying, they'd be like, no one's taking it seriously. So I think they need the market to do this, but they don't want to cause a stock market induced recession, or stall speed in the economy. And so I think that these indicators like yields falling, probably they wanted, but then they don't really want consumer confidence to fall. They don't want negative jobs report because all of a sudden this risks a recession, and recession dynamic is really dangerous. I mean, I think there's no inflation interpretation in the stock market. It's interpreting this as it's really going to hit growth. If the economy slips into a recession, you can't have Doge, tariffs, and fiscal austerity.
Okay.
So right now,
So it unwinds literally everything. Now, I might actually say if the federal government is reducing its spending and it does create this collateral damage, that's actually good for the economy because we know that has crowded out private sector spending, right? The government crowds out the private sector. So that's actually a positive that this is being redistributed in that way, the spending.
Yeah, but it's ugly in the short term.
Yeah, because it creates distortions.
Tom Lee challenges the conventional economic metrics, asserting that these metrics are often manipulated to paint a specific narrative, like labor statistics and inflation figures. The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Lee asserts this journey is just the beginning, comparing the initial years to the current widespread interest and investment, with a giant spotlight on Bitcoin ETFs. Lee highlights this being a significant development in the financial ecosystem, selectively measured to create desired effects rather than reflecting the true state of the economy. In this context, Bitcoin emerges as an alternative, detached from the manipulations of the conventional economic sphere. Lee also highlights that established corporations like Apple, Amazon, and Google will use their established relationships acquired over decades to swiftly acquire substantial amounts of Bitcoin through a spot ETF, bypassing the cumbersome processes involved in procuring the actual commodity. This disparity underscores the transformative power of cryptocurrencies in traditional financial institutions. Michael Saylor underscores the importance of embracing digital currencies as the economic landscape is changing rapidly, and urges investors to leverage Bitcoin's potential to secure a more prosperous financial future. What do you think about the latest interview with Tom Lee? And how do you think Bitcoin's trajectory in the coming months will impact the crypto market and the world of investing?